So they missed consensus on the bottom line today, but they actually managed a slight beat on revenue. The stock is taking a bit of a hit, down about 2% in pre-market trading. Q2 2026 revenue hit 5.612 trillion Korean won. Operating income, though, swung to a deficit of 108 billion Korean won, and EPS sits at negative 838 won.
Right, and they didn't really give strict quantitative guidance for Q3 either, just some, standard forward-looking optimism.
Yeah, exactly. Just the usual management commentary.
Yeah.
But those are the hard numbers.
They are. And I mean, on the surface, seeing a massive capital-intensive manufacturer swing back into the red like that right after positive first quarter, it's honestly pretty jarring.
Oh, it looks terrible on the surface. We've basically spent the entire morning tearing through their Q2 earnings deck, reading through management supplemental notes, and, really digging into the raw cash flow statements to unpack what is essentially a profitability paradox here.
Yeah, it really is a paradox.
Because you have this situation where top-line revenue actually expanded, right? Up 1% quarter over quarter, despite some pretty serious seasonal headwinds. And yet, the bottom line slipped right back into a deficit.
Right.
So we are going to walk you through the underlying segment performance today. We're looking at the margin pressures, the balance sheet, basically trying to see what is actually happening beneath that headline operating loss. Because when you look at the raw data, the headline completely obscures the underlying machinery.
It really does. I mean, if you only look at that negative 108 billion won operating income, you'd assume the core business model is just failing.
You would, yeah.
But digging into the management commentary and the supplemental financials, you find a completely different narrative. Management explicitly noted that business operations actually remained profitable in Q2.
Wait, really? So when I look at this earnings report, the first thing I do is try to isolate the one-off charges. Because if you're holding this stock, seeing a massive negative number paired with management claiming profitability, that naturally triggers some skepticism, right?
Oh, absolutely. Retail investors are going to be hypercritical of that.
Right. But it looks like that operating loss was driven entirely by one-off costs associated with, quote, workforce optimization.
Yeah, that's the key phrase right there.
Right. So this isn't the ongoing cost of manufacturing glass or, selling displays. This is a strategic restructuring expense taken entirely in this specific quarter. So to prove the underlying engine is still working, I look straight at their EBITDA.
And that EBITDA remains solidly positive. I mean, it came in at 872 billion KRW, which represents a 15.5% margin.
Wow.
Yeah. I mean, yes, it's down from the 1.14 trillion they posted in Q1, but it's a massive validation that the factories are actually running and generating significant value before all the accounting adjustments factor in.
Yeah, the way I am thinking about this workforce optimization charge is from a purely structural standpoint. Like, compared to paying a massive upfront penalty to break a lease or maybe refinancing a mortgage.
That's a good way to look at it.
Right, because when a legacy manufacturer transitions to a highly automated technology like Wold in this case, they have to physically restructure the factory floor. They are likely automating legacy production lines or, retiring older workforce contracts associated with deprecating their LCD infrastructure.
Exactly. You take a massive upfront penalty buying out contracts, taking severance hits, which looks completely terrible on the income statement this specific quarter.
Right, it wrecks this month's bank statement.
But you only make that move to permanently lower your structural OPEX going forward. You take the hit today to structurally lower the fixed cost for Q3 and beyond.
Okay, but I have to push back a little here. If operations are still profitable, is the underlying engine actually healthier than the headline EPS of negative 838 KRW suggests?
Right.
Or is management just, sugarcoating a really bad quarter?
Well, to understand the scale of the non-cash adjustments dragging down that operating income, you have to look at the add-backs required to reach that 872 billion won EBITDA.
The depreciation.
Right. They had to add back a staggering 807 billion won in depreciation and another 173 billion won in amortization.
Wow. Okay, so we are talking about roughly $1 trillion in expenses that are purely on paper for this specific quarter.
Exactly. Purely on paper. We'll dive into why that depreciation number is so astronomically high later, but for now, it proves the core business is still throwing off cash.
Right.
I mean, even with the one-off labor costs dragging the operating margin down to a negative 1.9%, the gross profit still landed at 764 billion KRW.
So they maintain the gross margin.
Yeah, a 13.6% gross margin, which shows the fundamental markup on the physical products leaving the factory remains pretty stable.
Okay, so the underlying engine is clearly healthier than that headline EPS suggests. But if the core operations are still generating cash and they are holding gross margins steady at 13.6%, we really have to ask what exactly they're selling.
All right, the product mix.
Yeah, because if you look at the top line, revenue was flat year over year, literally 0% growth, and only up 1% quarter over quarter. If a company is generating nearly $1 trillion in EBITDA, you'd honestly expect a lot more top-line movement.
You would. And to reconcile that, we have to move off the financial statements and look at the physical unit economics.
Like the actual units shipped.
Exactly. We have to look at the actual glass rolling off the assembly line. Because the earnings deck tracks physical shipments in square meters of display panel area. And this is where the math gets incredibly interesting.
Yeah, I saw this. In Q2, total area shipment jumped 12% quarter over quarter, reaching 3.6 million square meters.
Which is a huge jump.
It is. But the blended ASP, the average selling price, dropped sharply by 13%, down to $1,079 per square meter.
So volume is up double digits, but price per unit is down double digits.
Right. And if you are shipping 12% more physical product to your customers, but only eking out a 1% gain in total revenue, the immediate fear for an investor is a price war at the bottom of the market. Like, are they just slashing prices to clear out old inventory?
No, the underlying data points to the product revenue mix, not a price war. It's important to remember that not all square meters of display glass carry the same premium.
Okay, walk me through that.
Sure. So in Q2, the TV segment's share of total revenue jumped from 16% to 21% quarter over quarter.
Okay, so TVs became a significantly bigger piece of the revenue pie.
Exactly. Now, apply that to the physical dimensions of the products. A 65-inch or, a 77-inch television represents a massive physical piece of glass. It essentially eats up a huge portion of the mother glass in the fab.
Right, compared to like a smartphone screen, which is tiny.
Tiny by comparison, yeah. When the product mix shifts heavily toward large-size products like TVs, the total square meters shipped naturally skyrockets. The denominator in your pricing equation just explodes.
Ah, I see. So a smartphone screen uses a fraction of a square meter, making the revenue per square meter on mobile displays astronomical.
Right.
But a premium TV, even though it might retail for a high absolute dollar amount, consumes a massive sheet of glass.
Yeah.
So the revenue per square meter is fundamentally lower.
You've got it. You are actively diluting your blended ASP simply by changing the ratio of what you sell. You aren't cutting the price of the TVs or the phones at all.
You are simply pushing a higher volume of products that carry a lower price per area metric.
Exactly. And management explicitly stated in their notes that the revenue expansion was driven by this increased shipment of large and mid-sized products.
Oh, and they also noted a favorable exchange rate, right? Which acts as a structural tailwind for export-heavy manufacturers like this.
Yeah, the FX tailwind definitely helps the margins, but the fundamental driver of that volume price divergence is the physical reality of the mix shift towards larger panels.
It perfectly explains how a company can push 12% more physical glass out the door and only see a 1% bump in top-line revenue.
Right. The physical volume is growing faster than the aggregate value because the physical footprint of the core product is expanding.
That makes total sense. So if retooling fabs and shifting the product mix to massive QD screens is what drove the quarter, we really have to look at the broader strategic shift underwriting all of this capital expenditure.
Which is their absolute reliance on OLED technology.
Yes. This quarter seems to mark a definitive tipping point for their capital allocation, because OLED products now account for 57% of their total revenue.
That is massive.
I mean, crossing that 50% threshold is a structural point of no return, isn't it?
It absolutely is. It changes the entire operational posture of the company. When OLED was, say, 30% or 40% of revenue, they were effectively an LCD company trying to scale a next-generation technology.
Right, testing the waters.
But at 57%, they are now an OLED company managing the strategic managed decline of their legacy LCD business.
Which dictates where every dollar of R&D goes, where the executive focus sits, and how they allocate future CapEx.
Exactly. And looking at the segment breakdown, IT displays make up 36% of revenue, while mobile and others maintain 32%.
Management actually highlighted a solid shipment trend in mobile compared to the previous year, which is notable given that Q2 is traditionally a brutal, highly seasonal trough for smartphone builds.
The mobile stability is definitely impressive, but their commentary heavily emphasized the TV side. Specifically, strengthening Wold technology leadership.
Right. They are clearly trying to protect their moat in the high-end living room market.
Yeah. But the more crucial operational detail was actually tucked into their notes on the IT segment. They emphasized sustaining profit-focused business operations through efficient fab management and securing supply flexibility.
Okay, let's talk about the physical mechanics of efficient fab management for a second, because this isn't just an accounting term, right?
Not at all.
In a capital-intensive industry, a fab costs billions of dollars to build. The depreciation clock is ticking, whether those massive deposition machines are running or just sitting idle. And if a fab sits idle because mobile demand hits a seasonal wall in Q2, the unabsorbed fixed cost will completely destroy your gross margins.
Which is exactly why supply flexibility is the most difficult engineering feat in this sector. I mean, you can't just flip a switch to stop making mobile screens and suddenly start making IT screens.
Right, it's not just a software update.
No, it requires physically retooling the lines. You're swapping out shadow masks, recalibrating the deposition rates for different pixel densities, managing entirely different yield curves.
So it's like a massive factory completely retooling its assembly line on the fly.
Yeah.
You're essentially trying to scale up the incredibly complex high-end Wold technology for massive TVs while simultaneously rerouting your other lines so they don't bleed cash during seasonal lulls.
Exactly. And if they hadn't executed that flexibility this quarter, the underutilization costs would have eaten them alive.
Right.
The fact that they held the line on a 13.6% gross profit margin while navigating this massive structural shift to OLED and managing Q2 mobile seasonality, it proves their operational engineering is highly mature.
Okay, so the operational engineering is keeping the gross margins intact. But we have to ask how they are actually paying for this pivot. Because retooling fabs, optimizing the workforce, scaling Wold, it requires immense sustained capital.
It absolutely does.
So we have to transition from the income statement, which only tells us about the last 90 days of operations, to the balance sheet, which tells us if they actually have the runway to survive this multi-year strategy.
Right. And for retail investors looking closely at the capital structure, this is where the anxiety usually peaks.
Yeah, because if you look at this balance sheet, the leverage is intense. Total debts are sitting at 13.39 trillion KRW. Net debts are at 11.94 trillion KRW. And the liabilities to equity ratio is a towering 260%.
That is steep.
Right. For every dollar of equity, they are carrying $2.60 in liabilities.
It is a fundamentally heavy capital structure.
But if you are holding this stock, looking at the current ratio is what will really make you sweat. It sits at just 63%.
Yeah, that's the number people fixate on.
They have 11.6 trillion KRW in current liabilities. With short-term debts vastly outweighing short-term assets and the income statement showing an operating deficit, isn't this a massive red flag? I mean, how do they service this massive towering debt load while restructuring the company? Are they going to face a liquidity crunch?
Well, if you only look at the balance sheet snapshot, ringing the alarm bell on that 63% current ratio is completely justified.
Right.
But to understand the actual liquidity profile, you have to bridge the income statement and the balance sheet by looking at the cash flow statement.
Okay. And when I cross-reference the operating loss with the cash flow statement, the entire narrative of the quarter flipped for me.
Exactly.
In Q1, their operating cash flow is negative 51 billion KRW. But in Q2, they generated 1.157 trillion KRW in pure operating cash flow.
Yeah, the non-cash depreciation drag on the income statement completely masks the actual cash being generated by the business.
It's just wild.
When you add back that $1 trillion in depreciation and amortization, and you factor in their working capital management, how efficiently they're moving inventory and collecting receivables, the reality is that the core business is highly cash generative right now.
So they took 108 billion won operating loss on paper, but the actual cash in the business increased by over 1.1 trillion won from daily operations.
Exactly. Furthermore, they maintained a cash and cash equivalents position of 1.45 trillion KRW on the balance sheet.
So the 13.39 trillion in debt isn't a symptom of a failing business model. It is just the structural reality of OLED manufacturing.
Right. You have to borrow billions to build the fabs capable of producing these next-generation displays at scale. It is the absolute cost of entry in this sector.
Right. You leverage the balance sheet to build the capacity, and then you rely on operational cash flow to service the debt while the assets depreciate over time.
Exactly. And the positive operating cash flow of 1.157 trillion proves that they are successfully generating the liquidity required to service that debt. even during a transitionary quarter where they took a headline deficit due to workforce
The
restructuring.
balance sheet is heavily leveraged, sure, but the cash flow statement proves it is a sustainable leverage. They have the financial runway required to execute the final stages of this OLED transition.
As long as that operating cash flow remains robust, the 63% current ratio is manageable. They are converting their operations into liquid cash fast enough to meet their short-term obligations.
Okay, let's synthesize this for you as you digest these Q2 2026 numbers. We started with a headline operating deficit that looked like a major red flag for the core business.
Right.
But as we pulled apart the segment performance and the cash flows, we saw that the deficit was driven entirely by one-off workforce optimization costs, which is a strategic move to automate and lower future run rates.
Yeah, that headline loss completely masked a quarter where actual cash flow surged to over 1.1 trillion KRW.
And that cash generation was driven by a massive 12% jump in physical shipments, heavily weighted toward large walled TVs.
Exactly. They executed incredibly efficient fab management to keep utilization high and gross margin stable at 13.6%, even during a seasonally weak period for mobile.
And they officially crossed the threshold where OLED is now 57% of their total business, marking a true point of no return for their long-term capital allocation.
It is a textbook example of why the headline EPS rarely tells the actual story of a capital-intensive manufacturer in transition. You really have to look under the hood.
You do. Now, before we wrap up, we want to leave you with a structural financial question to ponder on your own regarding this specific stock.
It's a big one.
Think about the sheer size of the depreciation expense on this income statement. It was over 800 billion KRW this quarter alone. That is a massive structural weight dragging down their reported profitability every single quarter.
Yeah.
But depreciation is just the accounting ghost of past capital expenditures. It is the cost of fabs they built years ago, finally hitting the income statement today. So ask yourself, what happens to this company's bottom line a few years from now?
Right.
What happens when those older billion-dollar fabs are finally fully depreciated? If they're already generating over 1 trillion won in operating cash flow while carrying the ghost of 800 billion won in depreciation, what does the EPS actually look like when that ghost finally disappears from the ledger?
I mean, it drastically alters the long-term valuation model for the entire company.
It really does. Well, that's all for today. If you want to keep unpacking the real operational mechanics hidden inside the financial numbers, make sure to follow the show for daily, no-nonsense earnings coverage. See you next time.